Good day, fellow investors. There were a lot of comments about calls, how it has a market cap of 1.6 billion, of 1.5 for enterprise value, of 3.1, higher debt, but that's just leases, not really. 1.5 just billion normal debt, inventory is high, book value is high. So for a really conservative estimate, 5.6 billion for a buyer of the company would be normal, and 10% covered easily the dividend of 10% and higher. So call could be a 4x from that perspective. Let's look at the business, and the CEO immediately starts discussing it with excuses, with how he's not happy, how things have to change. And whenever something like that happens in a presentation, you immediately know it's a turnaround story. They are trying to revert it. The problem is that even with Sephora and everything, people are buying less of these things, they are going less into these stores, and the outlook is pretty clear. 7-8% down sales per year compared to the year. That means also lower cash flows, lower everything. They are investing 500 million to try and to get more people into the stores. But if people change their behavior, that is the key risk. And yes, if we look at cash flows, there are significant cash flows over the year. Now those will be likely 200 million, so just to cover the dividend for the last 12 months. But the key is that they are lowering that, they are working on that. However, if we look at the cash flows, now the best quarter should be coming in, so this should revert, maybe zero, maybe 200 million. But given that people are changing how they behave, that's the key component here. Free cash flows, likely last 12 months, 400 million. With 10% down in traffic, we will be happy with 200 million. Compare that to the market cap, and that's a 10% free cash flow yield for the year, and that's exactly what the market is looking here. Yes, it was trading at 60 just a while ago, and that's a 4x if someone comes in and buys it at 60. The problem is that that was exuberant for retail, but somehow it looks that the customer changed its behavior, and therefore everything is going down. However, equity, yes, it is 4 billion. So even if someone pays 4 billion, that could be a good return. That's more than a 2x. But look at this. They repurchased common stock of 1.3 billion here when the stock price was, of course, 60, unfortunately. They could have solved the debt instead of doing repurchases. They could have had no debt at all. That is something insane. No, they pushed the stock price higher. They did some repurchases here, okay, but the bulk of it was done here just to push the stock price higher because we are so great. Nobody saw the change in, they did these repurchases. This was okay. The change in environment that led to the current situation, and that's how easily repurchases just destroy a business. The problem is that customer habits might be changing, and that's the key to know. If revenue keeps on declining, it gets just uglier and the value is just eroding. But yes, retail in general is cheap, 13% yield. If they can keep on doing it, then they will do great. But that's exactly what this is. It's a turnaround bet. High volatility going forward is to be expected. Their book value is very low. So this is a Benjamin Graham kind of investment where you have 100 of these in your portfolio, and then over time you should get to a good return. But just knowing whether call will make it or will not make it, or someone will offer just a little bit, 20% up over the price, that's very, very hard to know. Retail is in a tough spot, but customer behavior is really changing, and if less people go there, that likely means that the trend will be continued, less and less and less, and then the value simply crashes and we have Sears or something like that. So try to check whether customer behavior is changing. If that's changing, go away. How will they turn around it? They don't even know, because if they knew, then they would have already turned it around. Also, the risk and reward, manage that in your portfolio. That is key. It's impossible to know the future, but if we know what are the moving factors, that already helps in putting that into a portfolio. At 30% dividend and 30% price to book value, it's certainly cheap.